Okay, next little item on our agenda with gross income is, of course, prizes and awards. Yes, we all love these, especially when we get them. But we fail to realize that these are taxable items. Now, these taxable items, examples, of course, are winnings from television or radio shows, be it money or any item that basically has a cash value. We will have to report door prizes, lotteries, especially lotteries. We definitely know on that because you either get the choice of having the payments or basically having a big old lump sum where you went ahead and paid the taxes on it. Now, taxable amount equals to the cash amount or fair market value of the property. This is a big key item here. When we look at it, especially I would say in California, pretty much the state of game shows, I do know that in the state of California, after you've won something, you have to pay taxes to the state right then and there. In fact, little hint here is that mostly some people actually had to give up their prizes because they couldn't afford the actual the state tax on those items, which sucks. I mean, you won the item and then you realize I have to pay taxes. I don't have the money for that, so I have to give it up. Oh, that hurts. That stings when you got a new car. Or think about the whole Oprah incident. I remember that when Oprah, it's a classic meme, where everybody got a free car in their audience. Everybody had to pay taxes on it. Some of them didn't even get the car because they couldn't afford the tax on it. Again, that happens. Now, there is an exception to these, where the employee awards of tangible personal property received for recognition of length of service or safety achievement are excludable. Again, this is like getting the kind of like watch for the 40 plus years of service, something like that. Now, the maximum amount that we can exclude is $400. $1,600 at the award is known as a qualified plan award, which basically again is one of those like retirement length of service ones. Mostly we favor again the conservative side, which is the 400. There's a lot of rules and regs which we're not going to get too highly depth into. So let's give an example. Joseph, an employee of Vesuvius, if I said that right, that's awesome, Statuaries LLC, receives a clock for 20 years of service. It's an awesome clock because it is set at value at $1,500. This clock better be one of those awesome, like every hour it does a mechanical thing. I love those. But, okay. So the award is not considered a qualified plan award. Again, they're letting us know that already. Because mostly we're just going to focus on the regular. How much is excludable from Joseph's gross income? Well, the answer would be $400. Simple as that. Since it's not a qualified plan award, it's only $400. Now, if they did say this was a qualified plan award, he would get to exclude the entire $1,500. But he can't. So he has to basically record income of $1,100. Yeah. 20 years service, still have to pay taxes on it. Well, it happens. Alright. So, might as well throw another poll at y'all. And this is, of course, the thing that I was talking about, game shows. So, a game show allows contestants to select the prize that they want to play for in the bonus round. Eden is trying to decide between a car value at $45,000 and a cash prize of $35,000. Which should she choose? Okay. Again, since it's a poll, there's not really a correct answer. It's whichever way that you feel like that they should choose. Again, depends on situations. She might need that car, or she likes the cash. Now, either way, she's going to have to pay taxes on this. So, if she has the money available to pay taxes on the value of the car, that might be the better choice. Again, tax, title, and license. However, if it would be difficult to raise that extra money, she may be better off taking that lower value cash prize. That's already cash, and she can pay taxes very easy on the cash. Okay, as she can pay again. Alternatively, if she feels she can sell the car for the value listed, which is kind of hard to do because we all know cars kind of lose value as soon as you start driving them, and she does not actually want that specific car, she might want to take the car and then sell it and use some of the proceeds to pay the taxes. That just depends on which state she's in. Again, like I said, state of California requires that tax like right then and there. So for me, if I'm on a game show, I want to win some cash to go along with my prizes. Like, press your luck. I want to win some cash to go along with the new car that I'm probably going to win. As long as it don't whammy me out. Okay? So, that's it for this part. A little bit of information of prizes and awards. And again, it's always nice to actually know a little bit about it. So, again, prizes and awards are taxable. So for awards, you can have up to $400 if it's part of a basically retirement service or planned service award or safety. Okay, so let's go ahead and we're going to move to the next part.